Steve here. Today, we're going to pull back the curtain on something crucial, what I like to call the hidden tax of the Forex market. Yeah, it's the one cost that brokers don't exactly put on a billboard, but trust me, if you don't get a handle on it, you'll be scratching your head wondering why your account is shrinking, even when you think you're nailing your trades.
You've seen the ads, right? All of them promising zero commission trading. And it sounds incredible, doesn't it? But let's just get one thing straight. Nobody, and I mean nobody, works for free. The real cost, the way your broker actually gets paid, is baked right into every single trade you take, and it's called the spread.
So in this explainer, we're going to demystify this whole thing. We'll start with what this hidden fee really is, then we'll break down the two prices you always see, the bid and the ask. We'll get into why the spread is always changing, why it's the absolute worst enemy for short-term traders, and finally, how to respect it, not fear it. All right, let's get into it.
Okay, first things first, the hidden trading fee. When you boil it all down, the spread is simply how the broker takes their cut. It's their payment for giving you the platform, the tools, and the access to the entire market. Simple as that.
You know, the best way to think about it is like a cover charge at a club. You have to pay it just to get in the door. Before you've even had a chance to order a drink, you've already paid a fee. Well, in trading, that means you start every single trade slightly in the negative. It's just the immediate cost of doing business.
Now, that cover charge is calculated using the two prices you always see flickering on your trading screen, the bid and the ask. So let's break down exactly what those are.
It's actually pretty simple. The bid price is what the market is willing to pay you if you want to sell a currency, and the ask price is what the market is asking you to pay if you want to buy it. Now here's the crucial part. The ask price is always a little bit higher than the bid price. That gap between them, well, that's the spread.
Let's look at a real-world example with the EUR/USD. The bid price might be, say, 1.1616, but the ask price is 1.1617. That tiny little difference in the fourth decimal place, what we call 1 pip, that is the spread. So the second you click buy at the ask price, you are instantly down 1 pip. The market has to move 1 full pip in your favor just for you to break even.
Now, you gotta understand that this gap isn't fixed. It's constantly widening and tightening. And the reason for that all comes down to one single critical factor, liquidity. So when the market is really busy, I'm talking about when the London and New York sessions overlap, you've got millions of buyers and sellers all in there at once. All that activity creates fierce competition, and that forces brokers to tighten the spread to earn your business. This is when you'll see the smallest cover charge, sometimes even less than a single pip on the major pairs. But the exact opposite is also true. During quiet hours, like in the middle of the night or right around a huge news event like a Fed announcement, a lot of the big players step back. With fewer people in the market, liquidity just dries up and that spread widens out. And let me tell you, trying to trade a wide spread is like trying to swim with a weighted vest on. It's not impossible, but boy does it make reaching your profit target so much harder.
This brings us to a quick point on fixed versus variable spreads. A variable spread moves with the market, just like we discussed. It's tight when things are busy and wide when they're quiet. A fixed spread, on the other hand, stays the same no matter what. Now, it might be a little wider on average, but that predictability can be a huge advantage for beginners who just want to manage their costs without any nasty surprises.
This whole concept of the spread becomes especially critical for one particular style of trading, scalping. For scalpers, the traders who are in and out, just grabbing a few pips at a time, the spread isn't just a cost. It can literally be the difference between a winning strategy and a losing one.
Just think about this for a second. If your profit target on a trade is only 10 pips and your spread is 2 pips, you are giving away 20% of your potential profit before the trade even has a chance to breathe. You're starting at a massive disadvantage. The smaller your profit target, the bigger the chunk the spread takes out.
And this is exactly why the currency pair you trade matters so much. A major pair, like the Euro/USD, it might have a 1 pip spread. But if you decide to trade an exotic pair, like the US dollar versus the Turkish lira, you could be looking at a 50 pip spread. In that situation, you're basically starting the race a mile behind everyone else.
So, after hearing all this, the goal isn't to make you afraid of the spread. Not at all. The goal is to make you respect it. Because once you understand it, you can factor it into your plan and actually use that knowledge to your advantage.
So what are the key takeaways here? It's pretty simple. 1. Trade during busy market sessions when the spreads are tightest. 2. Stick to the major, most liquid currency pairs to keep those costs down. And 3.
always, and I mean always, factor that cover charge into your trade plan. Know your cost of entry before you even think about clicking that button.
So I'll leave you with a question to chew on. Now that you know every single trade has an entry fee, how are you going to adjust your strategy to make sure you're not just paying the house, but you're actually taking profits home? I'm Steve, watch the gap, and I'll see you at the open.